Welcome to DoubleLine's second annual Roundtable Prime, moderated by DoubleLine Deputy CEO Jeffrey Sherman. 5 thought leaders in today's financial markets will discuss their take on the economy and their outlook for the financial markets. Roundtable Prime was recorded on January 5th, 2021, and will be divided into 3 segments: global macroeconomy, financial markets, and best ideas. Each segment will be released separately once a week for 3 weeks in January. The roundtable guests, all with decades of experience in the financial markets, are recognized leaders in macroeconomic analysis, market research, and investment management. They bring together a broad array of knowledge across different sectors of the financial markets, including fixed income, credit, equities, real estate, and commodities. All have been sought after for their insights as speakers and as commentators in the financial media. And now, DoubleLine is pleased to introduce the honored guests of Roundtable Prime, our moderator, and our host. Jeffrey Sherman will moderate today's discussions. Mr. Sherman is Deputy Chief Investment Officer of DoubleLine Capital and a portfolio manager of a number of DoubleLine's fixed income and derivatives-based strategies. He also hosts the Sherman Show podcast series, which has featured many of today's distinguished guests and was named one of the 10 must-listen podcasts by Business Insider in 2020. Ed Hyman is chairman of Evercore ISI, where he heads the economic research team. For the past 45 years, Ed has been ranked by Institutional Investor Poll of Investors for economics and ranked number 1 for 35 years. Ed Hyman is highly regarded for his origination of econometric modeling and real-time surveys to gain insight into the unfolding business and market cycles. James Bianco is president and macro strategist at Bianco Research, which he established with the aim of originating insights unencumbered by traditional Wall Street research. His commentaries address such diverse subjects as monetary policy, the intersection of markets and politics, the role of government in the economy, fund flows, and positioning in financial markets. Jeffrey Gundlach, host of Roundtable Prime, is founder and CEO of DoubleLine Capital, an investment manager with investment strategies in fixed income, equities, real estate, and commodities. In 2012, 2015, and 2016, he was named to Bloomberg Magazine's 50 Most Influential. In 2017, he was inducted into the FIAZI Fixed Income Hall of Fame. Danielle DiMartino Booth. Danielle DiMartino Booth is CEO and Chief Strategist for Quill Intelligence, a research and analytics firm whose commentary appears in the Daily Feather and the Weekly Quill. Prior to Quill, she served throughout the credit crisis as advisor to Richard Fisher, president of the Federal Reserve Bank of Dallas. She is author of Fed Up, an insider's take on why the Fed is bad for America. David Rosenberg is president and chief economist and strategist of Rosenberg Research Associates, an economic consulting firm providing analysis and insights to investors. Prior to founding his firm, he was chief economist and strategist at Gluskin Sheff and Associates. From 2002 to 2009, he held those positions at Merrill Lynch in New York, where he was consistently ranked in the Institutional Investor All-Star Analyst rankings. Jeffrey Sherman, Deputy Chief Investment Officer of DoubleLine, will now open the second of 3 segments of Roundtable Prime, Financial Markets Outlook.
Rosie, you had your finger up.
Well, because I could have sworn 15 minutes ago you asked me or Jim Bianco about the views on value over growth. And I thought before we would break, I'd provide an answer for you because I don't think anybody's really addressed it.
Go for it.
Do I have time?
You're on the clock. Go for it.
Right. Okay. So, look, it cannot be denied that over half the household sector went into this crisis without enough savings, cash, liquidity to get through more than 3 months of vital economic activity. I mean, that is absolutely incredible. At a time of a 3.5% unemployment rate, a stock market that quintupled. Supposedly, someone had said up at the top that this was the best economy of all time. more than half the households in America had no savings, no cash flow, no savings, liquidity to get through 3 months of vital economic activity. And this was a trauma. I think everybody thinks that they have it all down pat. We're going to go flying again. We're going to go to the restaurants. But for how long? You know, that's why it's called the value trade, not the value trend. I could swear I was having these same conversations over a decade ago. Rampant fiscal stimulus out of Obama, huge, nobody knew what QE was, zero rates, negative real rates. And yet, in the last 10 years, despite all that stimulus, sluggish growth, low interest rates, very low inflation, and growth outperformed 80% of the time in that 10-year period. Now, wasn't 100%. I'll respect what Jeffrey said earlier that, very recently, off really a gargantuan valuation spread, value stocks have started to outperform. But it's a value trade. It's not a value trend. And Ed Hyman said this before, the savings rate's going to 20%. Now, I doubt it's going to stay at 20%, but we suffered a trauma. And we went into this with insufficient personal savings for many households. And so what comes out of this, and we've done the work, is that if the equilibrium savings rate before the pandemic was 7%, post-pandemic, it's going to be 10%. And if you don't think 3 percentage point gap of perhaps the most important behavioral aggregate out of the national accounts, which is the savings rate, is not going to have an impact on GDP, well, rest assured, that means that GDP will be depressed by roughly 1 percentage point against the benchmark growth that would have happened had we never had the pandemic. That's light beyond the light at the end of the tunnel. So I think we go into this period, we're going to have elevated personal savings rates. People are going to focus on what they need, not what they want. I don't deny the fact that we'll have 3 or 6 months of fun, and then reality is going to set in. And so I think that what's happened, and Jeffrey hit on this, is where, we all talk about the pent-up demand in restaurants and airlines and hotels. That's such a tiny fraction of consumer spending. It's next to nothing. We just talk about it. But look at all the money that's been spent on kitchens, on home improvement in general, outdoor patios, autos, furniture, appliances. And what's happened here when we're talking about what the fundamental changes that have happened, and maybe this is a positive, it's almost like we came out of World War II, and what were we building? Victory gardens. We become a do-it-yourself economy all of a sudden. All of a sudden, when you're taking a look, and I noticed this right away, when auto sales were plunging in March and April, what was flying through the roof were retail sales of auto parts. And then I started noticing that linens and sewing machines and clothing repair, so many things that we've been buying have been towards the home body economy. But in this process, we've learned how to cook. It was amazing to me. We talk about Campbell soup, for example. Never mind the Campbell soup sales to this day in the robust economy are still up more than 20% soup. But their online viewings of recipes on Campbell Soup's website is up like 30%. And the biggest increase is among millennials, those brats. But we're learning how to cook, learning how to change our own oil or parts in the car, learning how to actually repair our own clothes. So this has become a do-it-yourself economy. So it's back to basics. But what it's telling me is that everything is leading up to growth over value, and not as a trade, but as a real trend like it was in the last cycle. Come on, let's face it. You want to be bullish on the value. If you think it's a trend, you're going to need that higher inflation. I got to tell you, we can talk about inflation because that's all we talked about last year, and that's all we talked about 10 years ago. It's not around the corner. You want the value trade to work and become a trend, you need inflation, you need sustainably higher interest rates, and you need accelerating growth. And for the people that believe that's going to happen, have to answer back, why didn't it happen when you were saying the same thing exactly 12 years ago? It's going to be very difficult. I'm trying to say right now, you can have your own inflation forecast. I get that. You need inflation to get the value trade to work. You really do need inflation. Where's it going to come from? Okay, somebody said wages, absolutely. We still have a massive resource gap in the labor market. But the other thing to keep in the back of your mind, out of the CPI, is people talk about commodities. You don't walk down the aisle of Walmart and buy a pound of copper, okay? The biggest component of the CPI is rents. Imputed rent and actual rent together are over 30% of the index and 40% of the core. Have you looked at the chart of residential rent disinflation? And that's going to continue for at least the next year. I'll tell you, maybe we get to 2.6 in Jeffrey Gundlach's model. Maybe that's true, but maybe it's 2.6 on the way back down to 0 or 1. But the one thing I'll say is that there's no more important determinant within the construct of the CPI than residential rents. And you're looking at vacancies, tracing it out to rents for the next 12 to 18 months, it's going to be in one direction and it's down. But without the inflation, the value trade's just that. You can trade it, have fun, but the growth part of the market, notwithstanding the valuations, is still going to be the outperformer over time.
Well, the value trade, it's kind of late, frankly. I mean, it's had such a powerful reversal. But I was struck, Rosie, what you said about 10 years ago, we were talking about certain things. It jogged my memory. I was looking through some old webcasts that I did, and I stumbled on one from 2011, and I went through the charts, and I was shocked that I almost could have used exactly that same deck today. The themes were identical. Zero interest rates promised by Ben Bernanke, quantitative easing, inflation AWOL. It was exactly the same. And it struck me that in a certain sense, it feels to me that we never really got out of the global financial crisis. We're using exactly the same tools that we used then. We have much more, we're just using more of them and more aggressively. And all these themes seem very, very similar to where we were. And employment isn't really that much higher than where it was in the global financial crisis. In fact, during the middle of the year, during the lockdown, we had fewer people working than we did at the depths of the global financial crisis. So I'm not sure whether we're out of the recession or not. I know in technical terms, we've seen, a great quarter in the third quarter, and the fourth quarter is going to certainly be positive. But have we gotten back to where we were in the first quarter in terms of nominal GDP? I don't think so. So in my view, I'm not really sure if we're out of the recession or not. I have created my own definition of being out of a recession. I just did it this year, or last year, 2020. And that is, I'll declare that we're out of the recession when we go to a new peak in nominal GDP and real GDP.
Can I ask you about this one barbell that I've been thinking about? Because you're the you're the global debt guru. But I'm thinking that, what would you think of this? Because I agree with you on the long bond, because if this is what we get, 170 on the long bond after the risk on trade, and Danielle talking about the multiples. I mean, this is what we get, 170. And what if things go? What if things disappoint, go the other way? So you have the long bond on one trade about, say, an earnings relapse or something that goes wrong. On the other side, if things recover, what do you think about the other side of the barbell, or companies that moved into fallen angels in the crisis that in recovery get pushed back into investment grade? What do you think of that as a barbell, good news, bad news investment strategy?
You're talking about bonds now?
Yeah. Well, I'm talking specifically about bonds, since part of this was, Mr. Sherman was talking about, making this markets oriented, and we talked a lot of time about the stock market. But a couple of things that were triggered is, what if Ed Hyman is right that we do get a more durable recovery? Where would be a place again that nobody's talking about that could make you money without taking on equity risk? And it could be all those fallen angels might get re-rated back into investment grade. But then if we actually have our scenario where things could relapse, you'd want to have the long bond. So I'm just talking about that as a barbell scenario. What you would think about that?
I think it's one of the more attractive strategies in the fixed income market. What you have to do is have a deflationary sort of a hedge, and that's the 30-year treasury. And then you have to go into the places where angels fear to tread, and that's in the places that are beaten down by the lockdowns and by the idiosyncrasies of the uneven recovery. So you could go to fallen angels. You could go to certain parts of the energy sector that don't really have a full recovery prospect. If oil is below $50, which it still sort of is, I know it hit $50 today, you really need it to go higher than that. You could also, I know that some people have dire forecasts for parts of the commercial real estate market. And certainly if we don't recover, those will probably come true. But if we do recover, then those areas that remain beaten down, those are fallen angels too. It's a little late for a lot of these trades though. Once the vaccines were reported, we saw a pretty large rally. I mean, that's what drove the Russell 2000 into a great November, where it was the hopes for vaccine. And it's also probably, it certainly helped parts of the CMBS market and some parts of the junk bond market already. So it's a little late for that part of the barbell, but given what the menu looks like in fixed income, I still think that it's less attractive than it was, but it's still one of the more attractive strategies that I think can be implemented. Because after all, if you're buying the Barclays aggregate index, you're looking at something that gives you a return of just about zero when you factor everything in. And so you need to take risk on one part of your portfolio. And that's why the barbell makes sense.
Danielle, I know you want to speak, but Rosie, just on that point, there is an ETF out there that traffics in fallen angels because we watch it. And I think it was up almost 15% last year. So a lot of that value has been squeezed out of there from the Fed being a supporter of that corporate bond market. A lot of those were eligible. But go ahead, Danielle. I think you wanted to say something.
Actually, it's exactly to what your point was. And what nobody has actually mentioned, and this was more macro, but it pertains to what I'm about to say, is that you have to go back to the double dip recession of the 1980s or the great financial crisis to find more than 4.5 million permanently unemployed Americans, which it's fully anticipated that number is going to continue to rise. But again, you cannot look back to 2001. You can't look back to 1990, 1991 to those recessions, because permanent unemployment right now is higher, and it is going higher as more middle management continues to get gutted as a factor of time. But what we haven't talked about is, Jeffrey was saying that he was looking back 10 years and he could have used a lot of the same graphs, but what's changed is the balance sheet. 10 years ago, 12 years ago, it was the household balance sheet that was in a tatters. Today, we've had more than a doubling of the corporate bond market. And last year when we were talking, 38%, according to Morgan Stanley's math, of the investment grade market should have been rated junk, and it wasn't. So they were 38% of the IG market had an inflated rating. I know that we both have the same exact graph on hand. Today, fast forward, that is 56%. 56% of the investment grade bond market should otherwise be, in a real world, rated as junk. So your credit risk, even as corporate America's tacked on another $3 trillion of debt this year, your credit risk has actually grown as a factor of time. And if there's one area of the market that is priced to perfection, and to your point, Jeffrey Sherman, about the Fallen Angels Fund being up 15%, it is investment grade debt. So, we came out of the great financial crisis with non-financial debt holistically, including all loans, at 74% of GDP. We entered 2020 at 78% of GDP. As of the third quarter, it had risen to 91% of GDP, both coming into 2020 and where we are today and where we'll end up the year. These numbers are unprecedented in US history back to the beginning of mankind. So I think it just bears mentioning that one of the unintended consequences of the Fed policy bailing out the corporate bond market is that if we enter 2020 with a corporate bond market bubble, we are entering 2021 with something that is a magnitude of that.
I'd just like to say one more thing about that, Danielle, because everything you're saying is important. But don't forget that the maturity of the corporate bond market has extended massively too. It used to be the corporate bond market had a duration of about 6, and now it's about 9. So your interest rate risk is way up there too. So like I said earlier, it's tough to find a way to win here, because if rates go up, you lose, and if rates go down, you're probably going to lose on corporate debt being downgraded. And as we all know, when a bond goes from BBB to BB rating, the price does not go up.
And to your other point, if you look at CMBS and if you look at CRE, including loans, and if you look at investment grade, you've got refinancing risk in the immediate, Not so in junk bonds. Not so in junk. You got $45.8 billion of junk bonds that have to be refinanced in 2021, which it's a rounding error when you consider that there was almost 350 billion issued in 2020.
When you take into account the call risk in the junk bond market, and you do that by adjusting the yield for the callability, it's called an option adjusted yield. The yield on the high yield so-called junk bond market, I agree with Rosie, we can't call it high yield anymore. The yield starts with a 3 on a call adjusted basis. So why would you want that? I mean, you might think stocks are overvalued, but the party rages on. I mean, it's true that stocks look overvalued, but they don't look overvalued versus the corporate bond market.
It puts a 1.7 on the long bond into perspective, that's for sure.
Indeed.
Jeff,
All
can
right.
I add one thing here for the discussion? We do these company surveys every day, and our trucking survey of all the surveys has the highest correlation with GDP of any single sector survey. And I just got it a minute ago. It's up 2 points to 69. It's the highest since 2005. Our airline survey this week was 12. But I say the economy is very bifurcated. But I think the economy is about to take off here, guys.
Well, I think, your underlying thesis behind the taking off has to do with stimulus and money. And
That's correct.
I would say that the evidence is pretty convincing that if you have, at least in the short term, that if you have ongoing stimulus, that you probably will have it translate into short-term economic growth that's pretty solid.
You could
And
also,
then the second half of the year, you get the vaccinations.
well, and I think there's also a case to be made under a Biden administration for an FHA bailout, for these forbearances to get extended, for the rental eviction moratoriums. I mean, it'll have to be targeted and address landlords who are in distress, because 48% of all landlords are small business owners. But there's an extraordinary amount of money that households in the lowest income quintile don't have to spend, in addition to the stimulus money they're going to get and spend immediately.
Go, Jim.
Yeah, I was just going to say, keep in mind that all of this is, look, you can make a plausible scenario that it's going to happen, and I agree with it, but a lot of it's priced into the market already. You're buying a market that is fully valued, if not overvalued. It is already priced in a lot of this positive that we're hoping for as well. The vaccines are coming, the stimulus checks are coming, the money's coming, it's already in the price. That's why you're paying near record multiples for a lot of markets, not even individual stocks, but a lot of markets in anticipation of this happening. Any wobble or any disappointment along the way will be met very poorly by these markets if you don't give them what they've already priced in.
That's a good point, Jim.
Can I ask a question?
Go ahead.
Just based on, because once again, because the view that we're going to get some economic boom, and the view is that we're going to get some pent up demand release in hotels, in air travel, in restaurants. What share of consumer spending is that? Jeffrey Gundlach said something really important. And this went to the heart of when Ed Hyman talked about that V-shaped recovery. What people spent on remodeling their house, buying a third car, redoing their backyard, all the appliances and furniture and electronics. Like, you're not going to renovate your home again. You're not buying a fourth car. So everybody talks about this pent up demand. We can't wait to go to the restaurants. Well, how many restaurants do you have to go to in a year that's equivalent to buying a brand new car? Okay, because we're talking about GDP here. Nobody talks about the fact that this past year, when you're looking at spending on goods, it went more than $200 billion above what the long-term trend line was telling you. How come nobody talks about, when we go out back to the restaurants and when we start flying again and going to the casinos, nobody's talking about the fact about the pullback in the other parts of the economy that are going to act as a huge offset. So I don't know about this big boom. The New York Fed has already told us that 3/4 of this quotes stimulus, which is really relief, is going to pay down debt and go into the markets. So maybe it's great news for the markets. Most of it's not going into the economy. And then on top of that, nobody talks about, everybody just wants stuff because I understand the bullish narrative. It's so nice and it sells so well. But nobody they give a partial picture on the pent up demand of all the consumer services we couldn't do, which is a small fraction of consumer spending. But they don't talk about the fact that we had so much of demand on the good side pulled forward for years in these past 9 or 10 months. That actually good spending is going to go down as these pent up demand services go up. And the net incremental boost to GDP for all the euphoria is 1% add, 1% add to GDP. When you counter in, because nobody talks about the mirror image of the boost in service spending, is the decline back to the long-term trend in good spending, which wouldn't have happened without the pandemic. Nobody talks about that.
Let me tell you what that jogs my thinking on one thing. I've always been just increasingly amazed at the lifestyle behaviors of my younger employees as a sample, and I'm sure it's reflective of society at large. The amount of money that they just sort of throw away or threw away is what I'm trying to get at, on exotic vacations to Antarctica, on eating out constantly. And I just got to believe that those people have had some sort of lifestyle readjustment that is not going to be fully reversed. Somebody said, I think it was you, Rosie, people will buy what they need, not what they want. I really think that that's an enduring legacy of the lockdown economy.
Plus, you've had ownership at the same time. So you've got quite a few millennials who don't have the ability to shift their spending habits back to the way they were.
Yeah, so before we end this segment, I want to ask one last question as we think about the markets too. And there's been much ado made about the traditional kind of 60-40 portfolio. It's always a basis for thinking and illustrating, diversification, and had a killer year last year with the, if you just look at the S&P up, 18%, the Barclays Ag up about 7%, get you a nice double digit, type of 60-40 return. And we've talked about pulling returns forward. Rosie, you've been emphasizing that. The problem with having high returns is it augurs for lower future returns. How does one think about this type of model and think about this asset allocation today, given where valuation is on both the equity and the fixed income market? So jump ball for whoever wants to start us off.
Well, I have a thought on that, because everybody's talking about the yield on the long bond. And I'm not so sure that you're buying treasuries today because of the yield. Maybe you could argue that you're buying it because of the price. The one thing you didn't mention, you mentioned 18% on the S&P 500. Well, the long bond generated like a 20% return last year with no equity risk. Go figure that. And in fact, if you had a gold, I call it the bond bullion barbell, generated a blended return of 20%, again, with no equity risk. From my perspective, I know people talking to 60-40, however, through, I'm not sure, capital asset pricing model or Harold Markowitz, the 60-40 or 60-30-10, whatever it is. I've been saying all along that there's no such thing as a sure thing. If I've learned anything in 35 years in this business, no such thing as a sure thing. You don't put all your eggs in one basket. So I don't understand this concept of like the 60-40 just because stocks had a great time last year. You got to understand in your asset mix, what do treasuries represent? Jeffrey Gundlach said before about call risk. Is there call risk in treasuries? No. Is there default risk in treasuries? No. What other instrument on the planet do you know in time X with 100% certainty what you're going to get paid? What you're going to get paid at the time of maturity? Do you know with 100% treasuries are the ballast? And maybe the fact they're 1.7% of the long bond and where they are globally is really telling you nothing different than Danielle's 33 Schiller multiple, which is that expected returns over time are going to be quite low. I love all this talk about what the market did last year. Look at the meat grinder roller coaster ride. How many sleepless nights did people have? Did anybody know in like February, March, and April what was going to happen? That you're going to make all your money back? I guess we've been trained to do that. Look what happened in the fourth quarter 2018. Look at the volatility and the capital risk in equities. Here's the reality, which people can't ignore. You can lose money in the equity market. Now, you can actually buy bonds and not lose money. I mean, it depends on whether you're going to hold on to maturity or not. There's inflation risk and duration risk, but that's different risk than the risk you have in any other asset class. So I don't know, this whole thing about the 60-40 going the way of the dodo bird because the long bonds at 1.7 and the 10 years below 1% ignores the inherent safety characteristics that bonds have as a ballast in the portfolio. Very interesting. In the fourth quarter 2018, imagine if you're 100% equities. Think of what if you did not have exposure to treasuries in the fourth quarter 2018 as the stock market went down almost 20%. Think of what was happening earlier this year as the stock market went down and how bonds acted as a ballast in the portfolio. I think people have just people have lost their minds when they're talking about that 60-40, or there's no room in the portfolio for treasuries because of where they're trading. It's ridiculous. It's the safety characteristics you can't get anywhere else.
Real quick, and I'll kick it over to Jim because I see him raising his hand. One thing you got to think about though, Rosie, and I do worry about this, and I didn't used to worry about this, is that it's true that the 30-year treasury is presently not callable. And I use the word presently because the Federal Reserve wasn't allowed to buy corporate bonds either. And the Federal Reserve bought a lot of corporate bonds. So we're in a world where the rules get changed. And we entered that world really a long time ago when it came to the mortgage contracts underneath residential mortgage securities being completely dishonored. So I certainly agree with your point as a base case. In fact, I brought it up as you kindly credited me with, but I do worry. I think Trump actually talked about refinancing the outstanding treasuries. I don't know how serious he was and didn't get anywhere. But I worry that might happen in the context of $157 trillion of unfunded liabilities in the United States. Jim, I'll give it to you.
Real quick on the 60-40 portfolio, and more to Rosie's comments. This concept has been, this is why the entire wealth management business exists. A lot of these comments I made last year on this roundtable. Why does somebody go to a wealth manager? Because they're unsure about the future. If they were bullish, they'd put their money in the ARK Innovation Fund and they'd be done. But they're not. So they go to a wealth manager and the wealth manager says, at the end of the day, some version is 60-40. Here's some risky assets. And then here is a negatively correlated asset that will buffet you when the market goes down. And it's worked great. The question is, why has it worked great? Why do bonds and stocks have that big negative correlation, lack of inflation? If you go back and we've looked at this going back almost 100 years, when you have no inflation, you have a negative correlation between bonds and bond prices and stock prices. So they turn to, well, one is a good hedge for the other. We've invented risk parity and a whole bunch of other strategies on this basis. As Ed said, boy, we could debate whether we're going to get inflation, but I think we're all in agreement that if it ever shows up, this is the game changer squared is what it would wind up being, because so many things change at that point. What happens in a inflationary environment, or the perception of an inflationary environment, is stocks and bonds go like they were in the 80s and 90s. They're correlated to each other. They go up and down together, their prices. So the 60-40 portfolio doesn't do you anything. When they go up, you'd rather be 100% stocks. and both go down. So the bond leg is not doing you anything to protect you on the downside. So really, the question with the 60-40 portfolio is inflation going to return? If inflation is going to return, it isn't going to work. If we're stuck in a deflationary environment, and I know, Rosie, you think we are, then it will continue to work. That on the next down leg in the stock market, yields, especially treasuries, will approach zero. As long as you have a high quality mix of fixed income, you're not stuck in corporate bonds or high yield bonds, so you've got credit risk, that will provide you that benefit. So it really comes down to a very simple question, and that is, what does the future hold for inflation and for the 60-40 portfolio? And again, the whole entire wealth management business, I'll give you the statistics again. It's 13,000 wealth management firms. They employ 500,000 wealth managers. They have nearly 40 million accounts that there are 40 million people that they manage money for. Of those 13,000 firms, half of them are 2 people or less in size as well too. And so their whole business has been driven on this idea. Those 40 million people that go to a wealth manager, they're unsure about the future. That's why they go to a wealth manager. Like I said, if they were sure about it, they put their money in a spider fund or ARK Innovation, or they go buy Zoom by themselves, and they wouldn't need a wealth manager. So that's
Jim, Jim, I got to respond to that, because what I was saying before was what makes bonds, treasuries, special. And I talked about capital risk. Okay, we talked about call risk. Let's talk about capital risk. I went back 5 decades worth of data that captured inflation and disinflation. And not one period over a 5-year horizon did treasuries generate a negative return. 12% of the time, equities generate a negative return. And then if you're taking a look at the periods, like the min-max on returns, it's a lot tighter in treasuries. It's a different asset class. It is a diversification. And there's no doubt that you could argue that, in fact, we talk about inflation being horrible for the equity market. Historically, the equity market was a source, almost a hedge against inflation. Now we're talking about if inflation comes back, then equities are going to go down. I imagine that, that the value stocks will do very well in that environment. Maybe the stock market still goes down. But what I'm saying is this. It's basically just saying that with your steak, you want to have mashed potatoes, okay? And the bonds are the mashed potatoes. And so it's not one or the other. So I don't know about the 60-40. What I'm saying is that what makes Treasury special that no other asset class has is over 5-year intervals, it's never lost a client any money. That's the alluring characteristic.
So, I'm just going to jump in with one little footnote here. And again, I feel like I'm a historian today, even though I shouldn't be. But 1977 was the last time the Federal Reserve Act was opened. And that was when the second mandate of maximizing employment was put in. It was also happened to be a period where we were dealing with very high unemployment, very high inflation leading up to 1981, which was the last year that we really had to worry about rising bond yields. And we've been in a 40-year bull market ever since then. But again, to the point of reopening the Federal Reserve Act, if there is any time in the past 40 years that the probability is as high as it is today that could happen, it is when you've got Janet Yellen as the head of the Treasury Department. So to Jim's point, it's not that inflation is inevitable and in the permanent unemployment statistics, which is inherently disinflationary. It's that if you are going to have risk enter investors' minds as it pertains to the sanctity of the treasuries, just let the Fed monetize everything. But you can't do that unless you reopen the Federal Reserve Act. And I'm not saying it's going to happen, but I'm saying that the players are in place now between her protege, Jay Powell, and her being at the helm of the Treasury and the Fed. This is history that we're looking at, and the potential, as Jim points out, for inflation is something that is tangible. And it is why when you see the stock market decline by a point and a half, a percentage point and a half, and you don't see a single basis point move in the bond market, that is the risk that you're picking up, is that they've stopped moving inversely to one another because the risk is visible. I'm not saying it's imminent, but it's visible.